What are financial markets? Financial markets, which include the stock market, bond market, currency market, and derivatives market, among others, are any marketplace where trading in securities takes place. For capitalist economies to run smoothly, financial markets are essential. Any marketplace where securities are traded is referred to as a financial market. The forex, money, stock, and bond markets are only a few examples of the many different types of financial markets. These markets could involve commodities or securities that trade over the counter or are listed on regulated exchanges, OTC. A capitalist society's efficient functioning depends on the efficient operation of financial markets, which trade in all varieties of securities. Economic upheaval, such as a recession and unemployment, can happen when financial markets fail. Understanding financial markets. Financial markets allocate resources and provide liquidity for firms and entrepreneurs, which is essential for the proper operation of capitalist economies. Trading financial holdings is made simple for buyers and sellers by the markets. Financial markets design securities as a way to reward investors and lenders who have extra money, while also making that money available to those who need it, borrowers. One form of financial market is the stock market. Buying and selling different kinds of financial assets, such as shares, bonds, currencies, and derivatives, creates the financial markets. To ensure that prices are efficient and appropriate, financial markets primarily rely on informational transparency. Due to macroeconomic factors like taxation, the market prices of securities may not reflect their true value. Other financial markets, like the New York Stock Exchange, exchange trillions of dollars worth of assets every day, whereas some financial markets are small and inactive. A financial market that allows investors to buy and sell shares of publicly listed corporations is the equities stock market. New stock issues, often known as initial public offerings, IPOs, are traded on the main stock market. The secondary market is where investors buy and sell securities that they already hold, and here is where any additional trading of equities takes place. Financial markets types. Stocks markets. The stock market is arguably the financial market that is most prevalent. These are places where investors and traders can buy and sell shares that are listed by companies. Companies use stock markets, also known as equities markets, to obtain cash through an initial public offering, IPO, after which shares are traded between different buyers and sellers in what is referred to as a secondary market. Stocks can be traded over the counter or on public platforms like the New York Stock Exchange or NASDAQ, or else over the counter, OTC. The majority of stock trading takes place on regulated exchanges, which are crucial to the economy because they serve as a gauge of the economy's overall health, as well as a source of capital gains and dividend income for investors, including those with retirement accounts like IRAs and 401k plans. Investors and traders, retail and institutional, as well as market makers, MMs, and specialists who maintain liquidity and provide two-sided markets, are typical players in the stock market. Brokers are impartial middlemen who help buyers and sellers complete transactions but do not have any actual positions in stocks. Over-the-counter markets. An over-the-counter (OTC) market is a decentralized market in which players transact securities without the use of a broker, trading taking place online rather than at physical locations. The majority of stock trading is conducted through exchanges, while OTC markets may handle trade in some equities, for example, smaller or riskier companies that do not meet the listing standards of exchanges. However, some derivatives markets are only OTC, and as a result, they account for a significant portion of the financial markets. In general, OTC markets are much less regulated, less liquid, and more opaque, as are the transactions that take place there. Bond markets. A bond is a type of asset where an investor lends money for a predetermined amount of time at a fixed interest rate. A bond can be viewed as an agreement outlining the terms of the loan and the payments between the lender and borrower. Corporations, as well as cities, states, and other sovereign entities, issue bonds to fund operations and projects. Securities like notes and bills issued by the U.S. Treasury, for instance, are sold on the bond market. The debt, credit, or fixed income markets are other names for the bond market. Money markets. The money markets typically deal in highly liquid, short-term securities with maturities of less than a year. They are distinguished by a high level of safety and a relatively low rate of interest return. The money markets feature substantial volume trading between institutions and traders at the wholesale level. They include money market accounts opened by bank customers and money market mutual funds purchased by retail investors. Purchases of short-term certificates of deposit, CDs, municipal securities, or U.S. Treasury bills are just a few examples of how individuals might invest in the money markets. Derivatives markets. A derivative is a contract between two or more parties, the value of which is determined by an accepted underlying financial asset, such as a securities or collection of assets, like an index. The value of derivatives, which are secondary securities, is wholly based on the value of the primary security to which they are tied. A derivative has no value by itself. A derivatives market trades complex financial products like futures and options contracts, which derive their value from underlying securities like bonds, commodities, currencies, interest rates, market indices, and stocks, as opposed to trading equities directly. Futures contracts are listed and sold on futures exchanges. The futures markets, which use standardized contract specifications, are well regulated and use clearinghouses to settle and confirm trades, in contrast to OTC forward markets. Similar to stock exchanges, options markets like the Chicago Board Options Exchange, CBOE, list and oversee options contracts. Contracts on a variety of asset classes, including stocks, fixed income instruments, commodities, and so forth, may be listed on futures and options exchanges. Forex market. The market where participants can purchase, sell, hedge, and speculate on the exchange rates between currency pairings is known as the Forex foreign exchange market. Since cash is the most liquid asset, the FX market is the most liquid market in the entire globe. Daily transactions on the currency market exceed $6.6 trillion, which is more than on the futures and stock markets put together. The Forex market is decentralized and made up of a global network of computers and brokers from all over the world, just like the OTC markets. Banks, commercial enterprises, central banks, asset management businesses, hedge funds, as well as small-scale currency dealers and investors, make up the Forex market. Commodities markets. Producers and consumers exchange physical commodities such as agricultural items, such as maize, livestock, soybeans, energy products, such as oil, gas, carbon credits, precious metals, such as gold, silver, and platinum, or soft commodities at commodities markets, such as cotton, coffee, and sugar. These places, where tangible goods are traded for cash, are referred to as spot commodity markets. However, the majority of these commodities trading occurs on derivatives markets, which use spot commodities as the underlying assets. Commodity forwards, futures, and options are traded both over the counter, OTC, and on publicly traded markets like the Chicago Mercantile Exchange, CME, and the Intercontinental Exchange, ICE. Cryptocurrency markets. Cryptocurrencies, or decentralized digital assets built on blockchain technology, like Bitcoin and Ethereum, have been introduced and have grown significantly over the past few years. Today, a variety of independent online cryptocurrency exchanges offer hundreds of cryptocurrency tokens for trading. These exchanges provide traders with access to digital wallets where they can exchange one cryptocurrency for another or for fiat money like dollars or euros. Users are at risk of fraud or hacking because the bulk of cryptocurrency exchanges are centralized systems. There are also decentralized exchanges that function without a central authority. Direct peer-to-peer (P2P) trading of digital currencies is possible on these exchanges without the use of a real exchange authority to handle the transactions. Major cryptocurrencies can also be traded in futures and options. Financial markets examples. The financial markets are evidently large in scope and scale from the previous sections. We will analyze the importance of stock markets in getting a company to an initial public offering, IPO, and the role of the OTC derivatives market in the 2008-2009 financial crisis to provide two more specific instances. Stock markets and IPOs. A business will require access to funding from investors as it grows. The requirement for access to far bigger quantities of capital than the company can obtain through continuous operations or a conventional bank loan arises frequently as the business expands. Companies can raise this amount of capital by selling shares in an IPO to the general public. This transforms the company from a private business with a small number of stockholders to a publicly traded business whose shares will subsequently be held by a large portion of the general public. The company's initial public offering, IPO, also gives early investors the chance to sell off a portion of their holdings, frequently with very generous payouts. Initially, the underwriters typically determine the IPO's pricing through their pre-marketing procedure. The price of the company's shares will alter as investors and traders evaluate and reassess their intrinsic value, as well as the supply and demand for those shares at any given time after the company's shares are listed on a stock exchange and trading in them begins. MBS and CDOs, OTC derivatives and the 2008 financial crisis. The mortgage-backed securities market has been largely acknowledged as one of the causes and aggravating aspects of the 2008-2009 financial crisis, MBS. These are a particular class of OTC derivatives in which the cash flows from various mortgages are bundled, divided, and sold to investors. The crisis was the consequence of a series of incidents, each of which had its own catalyst and culminated in the banking system coming dangerously close to collapsing. The Community Development Act, which required banks to relax their credit restrictions for customers with lower incomes, has been blamed for sowing the seeds of the crisis and establishing a market for subprime mortgages. The quantity of subprime mortgage debt, which Freddie Mac and Fannie Mae guaranteed, kept rising until the early 2000s, even as the Federal Reserve Board started to sharply lower interest rates to prevent a recession. A housing boom was sparked by the availability of cheap financing, which led to speculation driving up house costs and causing a real estate bubble. In the interim, investment banks used the mortgages they had acquired on the secondary market to establish a type of MBS known as collateralized debt obligations, CDOs, seeking quick profits in the wake of the dot-com bust and the 2001 recession. Investors were unable to comprehend the dangers involved with the deal since subprime mortgages were packaged with prime mortgages. The housing bubble, which had been accumulating for several years, had finally burst when the CDO market heated up. Subprime borrowers started to default on loans that were worth more than their homes as housing prices dropped, hastening the slide in prices. Investors tried to sell the liabilities after realizing the MBS and CDOs were worthless due to the toxic debt they represented. The CDOs, however, lacked a market. As a result of the subsequent wave of subprime lender bankruptcies, the financial system's upper tiers experienced a liquidity crisis. Lehman Brothers and Bear Stearns, two significant investment banks, failed over the course of the following 5 years as a result of their exposure to subprime loans. A taxpayer-funded bailout saved a number of the big banks that were about to fall. Thank you for watching this video. In the next video, we will discuss more on financial topics. Don't forget to subscribe and hit the like button and leave a comment.